We hope that the webinars are going to be an easy and a convenient way for you to learn a little bit more about philanthropy, different trends in charitable giving, and help you increase your impact. Today we are delighted to have two experts who will discuss ways that you can convert your treasures, which may be any different kind of real property, and both the speakers will talk about the array of property and assets, but this can be converted into charitable assets that can be contributed to us here at the Jewish Communal Fund and converted to use for your philanthropy. And they'll cover different tax issues around that and a bit about the procedure of how this all happens. Before I introduce the speakers, just a technical piece here. If during the presentation you decide that you would like to direct a question to one of the speakers, you are all muted. So you're going to need to type your question in the chat section and send your question in that way. You're not going to be able to ask it over the phone. We won't be able to hear you. And now I'm pleased to introduce Amanda Nussbaum, who is a partner in the tax department at Proskauer and is a member of the Private Investment Funds Group. Amanda's practice concentrates on planning for and structuring of domestic and international private investment funds, including venture capital, buyout, real estate, and hedge funds, as well as advising those funds on investment activities and operational issues. In addition, Amanda advises not-for-profit clients on matters such as applying for and maintaining exemption from federal income tax, minimizing unrelated business taxable income, and structuring joint ventures and partnerships with taxable entities. Our other speaker is Karen Goldberg, who's a principal in the Private Wealth Advisory Group at EisnerAmper, where she leads the trust and estate practice in the New York office. Karen has specialized in estate planning for closely held business owners, senior corporate executives, and other high net worth individuals. Her expertise includes an in-depth knowledge of estate gift and fiduciary income tax, as well as postmortem planning. She is a current member and past president of the Estate Planning Council of New York. And it gives me great pleasure to turn this over to our speakers.
Thank you so much, Ellen, for that wonderful introduction. So as Ellen mentioned, Karen and I are going to be speaking today about making gifts of assets really other than cash and marketable securities. And what are some of the challenges that you may face both from the tax and non-tax perspective in doing so, and what issues to really be thinking about. So we thought we would first start just by giving some examples of complex assets just to get you thinking, and by complex we really mean just not as simple as cash or marketable securities. The first category is really private company stock, and by that we mean either C corporation stock or S corporation stock. We'll talk a little bit later about why it's really not good from a tax perspective to be gifting S corporation stock, but we still wanted to mention that as an option. The second category we'll be talking about are interests in partnerships and LLCs or limited liability companies. We'll then move on also to talk about gifting interests in private investment funds. Those could be obviously limited partnerships or LLCs, and what are the different types. We'll also discuss real estate and artwork. And finally, the last example is insurance, which we will not talk about today because we could be spending a whole seminar just talking about that.
So Amanda, can you give us an example of some private investment fund interests?
Sure. So when people think about private investment fund interest, they generally may be thinking about interest in, the GP's incentive allocation or carried interest. But that category is really a lot broader. It includes, first of all, interest that you may hold as a limited partner in funds. So even if you're not actively engaged in the fund and not a member of the GP, maybe you hold an interest as an investor. It also includes stock of portfolio companies that funds hold. Maybe there's a way for the fund to distribute that stock to you as an individual and be able to gift that. And finally, it also includes interest in co-investment vehicles. And we'll talk a little bit later about whether in the case of carry and LP interest, whether if you have both, whether you can give one and not the other.
What are some of the concerns that we should focus on when giving interests such as these to charity?
Sure, Karen, that's a great question. So some of the concerns that we think about, besides for obviously the tax side, are we need to think about liabilities. And we'll talk about some examples of that. And that may differ depending on whether you're giving a gift in, for example, real estate, or giving a gift in an entity where you may have limited liability as a result of holding that. We also are going to talk about valuation, which is obviously a key concern for you as a donor, because it impacts what the amount of your gift, of your charitable deduction could be. We'll also address a little bit liquidity and timing, which could be a key concern for the charity rather than necessarily the donor, even though it could be a concern for the donor as well to make sure that the deduction will be respected as a valid charitable deduction. Transferability is another big concern, because while you may want to make a gift, it's possible that the underlying documents may not permit the gift, or may permit the gift but only if modified. And then finally, this we will spend a fair amount of time talking about today, are tax issues associated with the gift. So Karen, when you're thinking about a gift of property, are there situations where you may not receive, a full deduction?
Absolutely. And a lot of us are familiar with the common situation. You buy a ticket to a charity function, you pay for the ticket, and you think you're getting a full charitable income tax deduction, but you got that chicken? It wasn't that good, was it? But there's some value to that. So that's reduced. The value, the cost of the ticket, which you think is a charitable deduction, is reduced by the cost of that chicken dinner. So you get somewhat of a limited charitable income tax deduction. But this rule kicks in other places. Let's say you have a property and you want to give it to charity. You plan on selling it to charity for less than fair market value. This is what we call a bargain sale. And you sell it to charity for less than fair market value. There's a gift element to that. There's a charitable gift element to that, and there's a gain or loss that can be triggered upon that sale. That bargain sale rule can also apply when an individual contributes property to charity that's encumbered by a mortgage, or when an individual purchases a gift annuity. There's a disposition element to it for income tax purposes, as well as a charitable income tax deduction attributable to that transfer. So,
Karen, just one question
sure.
on that. Does it make a difference if, let's say, the debt is non-recourse, or if, let's say, the donee doesn't assume the debt?
Even if the donee doesn't assume the debt, it's still considered, there's still a disposition. But let's take a step back and talk about the bargain sale rules and when they apply. So an individual sells property to charity for less than fair market value. To the extent the fair market value exceeds the receipt, the sales proceeds, that's a charitable contribution on the part of the donor. The difference between the proceeds received, the sales price, and the adjusted basis, and that adjusted basis is allocated between the charitable piece and the piece that's sold, there's a gain or loss, or on the disposition. Presumably clients only transfer property with a built-in gain, so there'd be a gain. A portion of the basis would be allocable to the sale portion, and there would be a gain tax to the donor. But he would also get a charitable income tax deduction to the extent the value of the property exceeded the sales proceeds. Now this bargain sale rule also kicks in when you have encumbered property, because when an individual gifts to charity property that's encumbered, it's deemed to receive sale proceeds out in the amount of the outstanding debt. So to the extent the value of the property contributed to charity exceeds that debt amount, that's a charitable contribution. But otherwise, there's a gain or loss in the disposition with respect to the amount of debt that's so-called relieved on the part of the donor. This bargain sale rule also kicks in, I'll take a step back, when an individual engages in a charitable gift annuity with a charity. This is when they transfer appreciated securities or cash to a charity, and they get back an annuity, presumably for their life. These individuals want an income stream for their life, and they also want a charitable income tax deduction. If presumably the present value of that charitable gift annuity is less than the value of the property they transferred. To the extent the value of the property transferred exceeds the value of the annuity they're receiving, they've made a charitable contribution. If they give charity appreciated stock, there'll also be a sale element to this.
Karen, just going back to the encumbered property example again. So what happens if I have a partnership interest and the partnership itself has debt, but I, as the investor, didn't incur any debt? So whether maybe it's a mortgage on real estate or the partnership, otherwise borrowed, do these rules still apply?
Absolutely. The bargain sale rules kicked in. It kick in either way, because as we said, whether the donor is obligated on the debt or not, this bargain sale rule will still apply if you transfer such an interest to charity.
That's definitely something people should watch out for.
Absolutely.
Right? So besides for, the rules that we spoke about where you may be receiving partial consideration, you also have to look out for gifts of partial interest. And in general, there's no deduction for a contribution of a partial interest in property that's not made, through a trust to a charity. So the classic example is, let's say I own a building and I want to donate use rent-free to a charity of the 10th floor office space in my building. You would not be able to receive a charitable deduction for that. But these rules are broader, but there are exceptions to these partial interest rules. Karen, what are some of the exceptions?
Well, let's say that you hold only a partial interest in property. Let's say you have a remainder interest in property, and that's the entire interest that you own in that property. You can definitely give that interest away to charity and get a charitable income tax deduction.
What about, Karen, though, if then I, let's say, purposely, right before I'm going to make a gift, subdivide and basically make, two interests in my property, and I gift one to my spouse and I retain the other. Would that work?
Well, the Treasury doesn't like that. So no, that isn't allowed.
What are some of the other exceptions besides for gifting all of what I have or gifting my entire interest?
Well, as long as you gift an undivided interest in every interest that you have in the property, let's say you, for example, you give a percentage of your entire interest in a property, you can gift that away. You don't have to give away the entire property as long as you give an undivided interest in the entire property. So usually it's a fraction of the property or a percentage of the property, every interest. But if you retain a substantial interest, let's say you give away voting stock. You give all your voting stock away, or maybe you just give away half of your voting stock. That's okay. But then again, what if you retain the right to vote that stock? That's a gift of a partial interest, and that's a significant interest. So no, you won't get a charitable income tax deduction for the gift of that voting stock. However, having said that, I have to say most of my entrepreneurs aren't giving away their voting stock. They're keeping that and giving away the non-voting stock.
And I think in the estate planning areas, this is generally called like a vertical slice, right?
Yes.
Where as long as you're giving a vertical slice or an undivided portion of each interest that the donor has, that would be okay. And I guess this raises the issue that we said we would get back to when we were talking about different types of private investment fund interests. So the question then comes up, if I have an interest in the general partner of a private investment fund and I have an interest in the carry, but I also then am a limited partner in that same fund and have put money in, can I give an interest in my carry to charity and not give an interest in my investor position as an LP? Do I have to give both? And I think the rules there are pretty unclear. Part of it may depend under state law as to whether each of those interests are viewed as separate property. But if they're viewed as the same property, the same type of interest, in order to be able to qualify for this not to be viewed as a partial interest, you may have to give a vertical slice of each. So it's something to be mindful for, that even though you may think of things as different things, could they be viewed as the same property and potentially impact this partial interest rule? Karen, are there any other examples of gifts of partial interests?
Sure.
Or exceptions to them, I should say.
Sure. There are exceptions to the partial interest rule for certain assets. And if an individual has a principal residence, whether it's personal residence or a farm, let's say, they can give a remainder interest in the home to charity and get a current income tax deduction for the present value of the remainder interest in that home. That's allowed. There's also allowed at a qualified conservation contribution. An income tax deduction is allowed for that, and that's a restriction placed on property in perpetuity in favor of a conservation purpose that's charitable. You can give an interest in a future interest in tangible personal property, but you can only take the current income tax deduction when you actually give away the property. So let me give you an example. A donor says, I want to give a piece of artwork to charity. I'm giving it to charity. Here you go. I've assigned it to charity. The museum, they're going to use it in the charitable purpose, but it's still hanging on my wall. You haven't made a charitable contribution. Not until you turn that painting over to the museum have you made a charitable contribution.
And we're going to talk a little bit more about artwork and some of those rules a little bit later. And also, you mentioned remainder interest in, personal residence, and we have an example that we're going to walk through to see what some of the issues there are as well. And then I guess the last exception, right, if the interest retained is insubstantial. But there you obviously have to be very, very careful to make sure really what's being retained is a de minimis interest. So I think now we're going to talk a little bit about some of the reporting requirements for non-cash donations. And these you can probably read through on your own, but just to make everyone aware of that you actually do need to report both as the donor and also as the donee. So Karen, what are some of those reporting requirements?
Well, I don't know that donors will necessarily focus on this, but their tax preparer certainly will. If an individual makes a non-cash property distribution of more than $500 and you aggregate all similar items, a Form 8283 has to be filed with their personal income tax return. This Form 8283 is filed by C corporations when the contribution of similar items exceeds $5,000. Donee organizations have their own separate reporting requirements where they have to file a Form 8282 if they dispose of charitable property contributed to them within 2 years. They have to report it to the IRS. Obviously, the IRS, if you're contributing in-kind property, is looking to see what the charity sold the property for 2 years later to see if the charitable income tax deduction you took is in line. That's one reason for doing it. But there is this reporting requirement that the donee organization must comply with, which is the filing of the Form 8282.
So before we move on, I just wanted to answer one of the questions that came up because it was in connection with the partial interest rule. For anyone who's asked about art, we will be talking a little bit more about art, so we're going to hold off on those questions. But I think a question came up where if you give 2 offices in your office to a charity, and then you rent these offices to other professionals for $2,000 a month, can you get a donation letter for that equivalent? I'm not sure if I fully understand the question, but in general, if you're donating rent-free space, that's the example of the 10th floor of offices that you're not once again gifting your entire interest, you can't take a deduction for that because you didn't have a corresponding income inclusion. So if you would have actually gotten the rent, then you would have paid tax on that $2,000 a month. If you instead just don't charge for that $2,000, then you don't have tax, but you also don't get a corresponding tax deduction. If that wasn't the question, if the person who asked it can then ask maybe a clarifying question. Okay, so I think we were moving back to talking about reporting requirements.
Okay, so on our slide, we talk about what needs to be reported on 8283. It's cash and not cash marketable securities, so you have to file an form 8283. It's only in-kind property. And but I did want to talk about more about the appraisal requirements and the form, what has to be reported on a form 8283.
Well, then, Karen, before you do that, just to turn back to why it's important that there is actually a donee form. And this is going to get to some of the issues we talk about later. And it also ties into appraisals and aggressive appraisals. People often, may ask, well, if we donate something and we take an aggressive amount, for valuation, how does the IRS actually know then, what we sell it for? So, and how do they know, not what we sell it for, sorry, what does the charity sell it for? And that's really the purpose of the 8282, that besides the fact that the donor organization actually signs part of the form that the donor actually files, the donor organization itself will need to file, as Karen said, that form if there's a disposition. So therefore, it's evidence as to what the actual sales price was, and if that mark, is very, very different from the price that was listed on the donor's form, that could potentially raise, some red flags.
Okay. Having said that, if a donor makes a contribution that exceeds $5,000, they have to get a qualified appraisal, and hopefully that will be in sync with what the charitable organization will sell it for if they do within 2 years. So again, you have to get an appraisal, but it doesn't have to be attached to the income tax return, unless, of course, the charitable contribution is over $500,000. We'll talk more about that. But the qualified appraisal, it's interesting. It must be made not earlier than 60 days prior to the date of the contribution, and not later than the due date for the income tax return, including extensions. So there's a window in which the qualified appraisal must be performed in order for it to qualify as an acceptable appraisal for charitable income tax purposes and for the donor to be able to actually take the income tax deduction. In addition to getting this appraisal, the Form 8283 has to also be signed by the appraiser. And this appraisal, let's go back to that, has to be a full appraisal. The appraisal should include a description of the property appraised, the fair market value of that property, and how its value was determined, that it was prepared for income tax purposes. The qualification of the appraiser needs to be disclosed, and the appraiser must sign it and provide his identification number. And you know what? This appraiser can't be related to the donor. It can't be the donor. Even if the donor is a qualified appraiser, he can't provide his own appraisal, or else he won't be able to take the charitable income tax deduction. And the fee for this appraisal, it can't be based upon what the appraised value of the property is.
You mean I can't have a fee that gets higher if the appraisal turns out with a higher number? That wouldn't work?
I think the IRS is concerned that the appraisers may have some incentive to increase the value of the item transferred in a way that's not appropriate.
So what happens if you actually... Oh, sorry. We're going to get to that, I think, in a minute. But what happens if you actually fail to, substantiate a deduction? But maybe we'll talk a little bit more first about when you need appraisals and when do you have to attach them to the return.
So as I mentioned briefly before, if the contribution of property exceeds $500,000, then that appraisal must actually be attached to the income tax return. Anything less with other than artwork, you don't have to attach the appraisal, but you should keep it in your records in case you're audited by the IRS. You need to have that appraisal. And if you have like-kind property of a like kind, and together they total more than $500,000, you must attach that appraisal to the income tax return. Now, this appraisal requirement doesn't apply to cash, publicly traded securities, non-publicly traded stock of $10,000 or less. That's closely held business stock. Inventory.
And what's the reason why it doesn't apply in the case of publicly traded securities or cash, right?
Well, we know the value of cash. Publicly traded securities, the value is the mean between the high and the low and the date that it's traded. So it's ascertainable. But I want to mention something. This has been asked in the past about publicly traded partnerships. They're publicly traded. We should know the value, right? But there's no exception for this thing for publicly traded securities doesn't appear to include PTPs, publicly traded partnerships. So if it's indeed formed as a partnership, you shouldn't. It seems like you still need to get an appraisal, even though you can go to the securities exchange and figure out the so-called value. There are various other items that are not subject to it. You can see it on our list. Basically, an automobile sold by the donee organization. Obviously, you don't need an appraisal for that. You know the sales price is your charitable income tax deduction, and various other kinds of unique type of property that there's no significant value to, essentially.
Great. So I think I was about to ask this a couple of minutes ago. So what happens if you don't substantiate your charitable contribution? And does it matter if a donor is a partnership or an S corp rather than an individual?
If you don't substantiate, it's going to be denied at the partner or shareholder level. I've had clients say to me, I don't really have the substantiation. Can't you just take it? And I said, no, I have an obligation as a tax preparer. I've actually had to have my client go out to and buy this, they have to hire an appraiser. And they're not too keen on doing that. But as I prepare tax returns, and I'm saying I'm not going to put it on your income tax return unless I know that you have an appraisal of that property. Because I can tell you the IRS is going to deny it. They're preparer penalties. I don't want to be involved in that. If the denial of the deduction doesn't apply if it's failure due to reasonable cause or not willful neglect, but your tax preparer should be telling you, or they should be asking for this appraisal. So I'm not sure why you might not have this appraisal if you have a qualified accountant telling you that you need it. What might be reasonable cause? And I don't know if you say, I prepare my own income tax return and I didn't know. That's typically not reasonable cause.
Yeah, unfortunately, you're right that ignorance of the law usually does not constitute reasonable cause.
Yeah, and I just want to jump in here for a second and say Jewish Communal Fund will not accept any gift of real property unless there's a qualified outside appraisal. We will not even move forward with the gifting process without that.
Thank you for that. So we've spent a lot of time so far talking about, issues on the donee side in terms of making the gift, in terms of things that can limit their tax deduction. So now moving focus for a minute, let's talk about, are all these gifts appropriate for the donee itself for the charity, or are there reasons why charity may not want to take a gift from the tax side? And Karen, before you actually mentioned publicly traded partnerships in the context of talking about the appraisal requirements, I think for our next slide in terms of talking about unrelated business taxable income issues, this comes up as well. So in terms of gifts of partnerships or LLCs, including publicly traded partnerships, potentially income from those partnerships could be taxable to the charity if that type of income is treated as unrelated business taxable income. And the sources of that income can either be operating income. So if you donate an interest in a partnership that, for example, runs a real business, The classic case on that was actually with NYU, where they were operating a macaroni factory. And also, if you donate an interest in a partnership that has leverage, or if you donate property that is leveraged, subject to special exceptions that apply in the donation of certain property with leverage, where there are certain exemptions for charities if they dispose of a property within a certain amount of time. We mentioned this earlier that you may not want to give gifts of S corps. Why? Because if you give a gift of an S corp, then all income from that S corp, and including income from the disposition of that S corp, is treated as taxable income. As unrelated, this is taxable income. So not all charities necessarily will take gifts that have property that will generate this type of taxable income, but many will, because even though it means some or all of the income in the case of the S corp will be taxable, still it's better to get $100 and to pay tax on it than it is to get no money at all. And we'll see when we talk through our case studies how UBTI or UBIT, unrelated business taxable income, potentially impacts some of the gifts. So moving along to maybe our first case study. So we'll talk a little bit about contributions of privately held C Corp stock. So Karen, what are some of the tax advantages of donating stock to a public charity? And we're focusing here on private stock, not marketable securities, to a public charity, which includes a donor-advised fund like JCF, versus also donating that same property to a private foundation.
Well,
Did we lose you folks? Karen?
sorry. Did we? As I was saying, I'm sorry I'm not sure if you missed this or not, but if you give closely held stock to a public charity or a donor-advised fund, such as the Jewish Communal Fund, you get an income tax deduction equal to the fair market value of the stock. And this way you've done away with, you don't have to, if you sold the stock and gave the proceeds, you'd be taxed on the capital gain, and you'd get an income tax deduction for your after-tax proceeds that you gave to the charity. On the other hand, if you gave the same non-publicly traded stock to a private foundation, this appreciated stock, you'd only get an income tax deduction for your adjusted basis in the stock. So it's much better to give it to an organization such as the Jewish Communal Fund or some other public charity. The tax benefits to you are much better. Also, if you give this stock to the Jewish Communal Fund or some other public charity, the limitation on the deduction, what the individual can take on his income tax return, he can take as much as 30% of his adjusted gross income. If he should give this same stock to a private foundation where he'd only get an income tax deduction for his adjusted basis in the stock, he can only deduct it up to 20% of his adjusted gross income. So it's, of course, much better to give it to a Jewish communal fund rather than your own private foundation.
Karen, so you were talking about gifting, appreciated securities, and presumably someone would want to do this before an exit event. Can you gift an interest the day before a sale or the date of the sale, or are there any limitations around that?
This question is asked me a lot, but not quite that way. I have clients who come in to me, I don't know them, and they have stock. And they're about to sell their company, and they say, I want to give it away. I want to give a piece of it to charity. I don't want to pay the capital gains tax. And I say, well, how close are you to the sale? Because if you're too close to the sale, even if you give it away, there's what we call an anticipatory assignment of income, and you'll still be taxed on that, on the gain, on upon the disposition of the stock, even if you gave it to charity. So the question is, how far along are you? Is it just there are a few things that have to be wound up, and it's not likely that the deal's going to fall through because you're just signing the final papers? At that point, it's too late. But maybe you're at the point where the shareholders have to vote on it. Maybe that's, you're far enough along. You're not far enough along where you can make a charitable contribution of the property today, and there won't be an anticipatory assignment of income.
I think the best advice, right, is to give as early as you can. But, if it's at the term sheet stage, you probably don't have to worry.
Right.
Even if the contract has been signed, then maybe you have to look at whether there really are material closing conditions. If there are material closing conditions, maybe you're still comfortable. If it's the date of the sale, right, where everyone's in the room signing, clearly I think we all would find that to be problematic. But besides for tax, there are other things you need to think about when you're contributing private stock. So you need to think about transfer restrictions. Maybe there's an issue where you're not permitted under the actual governing documents of the corporation to transfer those securities, or maybe there are limits. Maybe you're permitted to transfer, the securities, but the voting stock has to stay, with the corporation. You need to, look at those restrictions, those documents, and shareholder agreements. You also need to think about, are there any risks, this is really from the charity side, but as a donor you should be thinking about it too, to holding that stock, including the stock sale. Are there going to be indemnities that whoever is selling, that the selling shareholders need to be able to provide to the buyer? And are those indemnity obligations, those indemnification obligations, limited in any way? And that's something the donee definitely needs to be sensitive to. And finally, you need to think about the potential application of the excess business holding rules, even though there is an exception if the stock is disposed of within 5 years of the contribution. And that would really only apply if we were talking about, interest in very closely held corporations where the donor was still, maintaining a significant interest. So there are some other considerations that you would need to think about besides for all this. If we switch the scenario and instead talk about stock, we move and talk about a limited partnership interest. It could be in a hedge fund. It could be in a private investment fund. It could be in any type of vehicle that holds securities. We'll talk about operating partnerships a little later. So other considerations you should think about are, what type of interest is being transferred? Is it a GP interest or a limited partnership interest? And from the charity's perspective, that could matter in terms of liability concerns. You need to think about liquidity terms, because from the charity's perspective, they may want liquidity. They may not want to hold in a liquid asset for a long period of time. Or if you're contributing and JCF has a policy on how long it will hold assets for, illiquid assets for, that there needs to be a disposition generally within 2 years. But for you, from a donor, if you give something illiquid, to your donor advised fund, you won't be able to make further contributions out of your fund until that interest is actually monetized. You need to think about it. You need to think about clawback obligations. So potentially when you gift your interest, there could be, under the partnership agreement or LLC agreement, under the governing docs, an obligation for the partner to return distributions that it received. So the charity needs to think about, first, actual distributions it got, but also could it be required to return distributions that the donor received. Also need to think about leverage. We spoke about UBTI a few minutes ago. You need to think about leverage both from the donee's perspective and also, as Karen spoke about when we were talking about bargain sales, you need to think about the impact of leverage of the partnership on the donor and on its tax deduction. Also, the types of assets that are held by the hedge fund, whether it's a diversified portfolio, may impact whether the charity wants to take that gift, whether it's good for it to be holding something that's potentially not diversified. We can all think about, Madoff-type situations. And then finally, any tax reporting requirements. Karen went through those from both the donor and the donee's perspective when you're contributing limited partnership interests.
Amanda, isn't it true you might not even get a full fair market value income tax deduction if you give a partnership with, let's say, receivables, ordinary income assets, if they hold some of them?
So Karen, that's 100% true. So, we've been really focusing on partnerships that hold capital assets. Partnerships are different than stock. So when you donate your stock, if you've held stock, in a corporation and you've held that stock over 12 months, you know that you'll be able to get a donation equal to full fair market value. When you donate, and that's the same thing if you were going to sell your stock, you'd be able to qualify for the long-term capital gains rates. Partnerships are a little quirky, that while sometimes they're looked at as entities, sometimes they're also looked at where you have to actually look through the entity. And if the partnership holds certain assets like receivables, if it holds, for example, bonds that generate what's called market discounts, certain types of income that assets that produce ordinary income, then the donation may be partly you'd be able to get fair market value, but with respect to the partnership interest that's attributable to those assets, your deduction may actually be limited to cost basis. Just like if you gave those assets not held through a partnership, your deduction would be limited to cost basis. So now maybe distinguishing to talk about a contribution of an interest in either an LLC or a partnership that holds an operating business itself rather than securities. Karen, are there any additional considerations you should think about in that context, maybe from the tax side?
Well,
Just impacts federal filing requirements and federal tax.
no.
Comes up also in the MLP area, right? So even if you're thinking about something that's publicly traded, publicly traded partnerships, it's still very, very different than stock, right, in terms of impact.
Absolutely.
So another thing to think about is because there's UBTI, right, whether the agreement provides for tax distributions, which is great because then even if you have to pay tax, you'll actually be getting cash on a current basis that you can use to pay that tax from the donor side. From the liability side, though, really need to think about whether you now as a partner or member of that entity could potentially have an obligation to contribute further capital, whether it's a clawback or returning distribution, or whether there's a commitment concept in that vehicle, and after you get the interest, you're still going to be required to put money in. If not, maybe you'll be treated as a defaulting partner, and the partnership may have remedies against you. And from a limited liability perspective, a charity may think about whether it wants to use an LLC to hold that interest.
Karen, we're having trouble hearing you.
Hello? Can you hear me?
There you go.
Okay, sorry. Okay, so I guess next we'll talk about contributions of a remainder interest in a personal residence. So clients have come to me and say, I want to give the remainder interest in my personal residence to charity. And the first question I ask is there a mortgage on the property? Because remember those bargain sale rules we spoke about before? They'll kick in if there's a mortgage on the property. There'll be a deemed seal to the extent of the outstanding mortgage. But luckily in most cases they say no. And then we figure out what their charitable income tax deduction is, and we're set to go. But then there are all these practical aspects of it for the charity and for the individual. Who's going to be responsible for certain types of expenses, repairs, capital improvements, property taxes, insurance coverage. The charity's entitled to the remainder. The the person who has a life interest, our donor, is probably going to be responsible for non-capital improvements such as the real estate taxes, etc. But when it comes to capital improvements, that may be different. And I know that Amanda deals with the legal aspect of this, so I'm sure you've been involved in creating such contracts. So you could tell us more about that.
Sure. Thank you, Karen. So as Karen was saying, you definitely need to think about from a legal perspective, while you definitely want to receive this gift from the charity side, I'm very happy to receive the gift, what kind of information do you need to receive, about the residence itself to protect you? Because when we're talking about real estate, obviously you could be thinking about things like environmental liabilities. And you wouldn't want to be in a case where potentially there could be liabilities that exceed the value of that gift to you, and to be, unprepared. So you'd want to, receive a title report, potentially inspection rights. You want to know that the gift will still be there by the time you get to the remainder interest period. So you want to make sure that there's appropriate insurance on that property, and that, you're named as a beneficiary. So from a donor's perspective, you want to make sure the charity is named in order to be able to protect, their interests as well. Some other things, to think about. We're going to move on to talk about, artwork. And, there are definitely additional considerations to think about when you're making a gift of artwork. And I think the basic question, though, is when you contribute art, Karen, is art like stock? Do you automatically get a deduction, for the art? Or is that deduction equal to fair market value, only obtainable under certain circumstances?
No, it's not like publicly traded stock. It's a very special asset like any other tangible personal property. And you only receive an income tax deduction for appreciated artwork or tangible personal property. You only receive a fair market value income tax deduction if the charity to whom you give the property to, the artwork, uses it in its exempt purpose. So if an individual gives appreciated artwork to a museum and they hang it on their walls in the museum, they should be entitled to a fair market value income tax deduction. But if they turn around and they give this appreciated artwork to another organization that just merely intends to sell it, the donor is not going to be entitled to a full fair market value income tax deduction. They'll only get a deduction for their adjusted basis in that artwork. So it's important when a donor is considering giving artwork or any other type of tangible personal property to charity that they look to see how the charity is going to use that item. And just talking about partial interest, I know we talked a little bit about that. There are really strange rules or more complicated rules when it comes to artwork or any tangible property, giving a partial interest in that artwork. In order to be able to give a partial interest in artwork away, you have to actually own all of the artwork at the start. Then you can give a partial interest to, let's say, a museum who's going to use it in its exempt purpose. That's fine, but they have to be able to, let's say you give 10% of the artwork away. The museum should have possession of that artwork for perhaps 10% of the time in order for you to get that income tax deduction. Then let's say the next year you want to give away another partial interest in that artwork. Well, the value of that interest is the lesser of, let's say you're giving away 10% of the initial value of the property, or 10% of the value of the property in the subsequent year when you're giving away another 10%. So the rules with respect to artwork and giving away partial interest are very convoluted. And when you give away artwork, you should be careful about, especially if you're considering giving something other than the entire piece away, you should be very careful to comply with all the requirements.
Thank you, Karen. And are there also special rules that apply to other collectibles, other than artwork, or are other collectibles treated the same way as stock?
No, other collectibles are subject to the same rules as artwork. They're a collectible, they're a tangible personal property, and they are subject to the same rules.
And there are also different appraisal requirements for art than there are for stock, right?
Yes, you're required to have a qualified appraisal if the art, and attach it to the return if the contribution of art has a value of more than $10,000. $20,000. And in certain cases, you have to provide a snapshot or photograph of that artwork, a specific item of art that's worth more than $20,000. And you can ask for, if any item of artwork has a value of more than $50,000, you can ask for a statement of value from the IRS and use that for your charitable income tax deduction.
There's actually a whole committee, our committee, our panel, at the IRS. I think some of this stems, for some of the abuses that related to donations, of artwork. So there are special rules involving artwork and also other collectibles. And we don't really have time today to get into more of the details, but it's definitely something which could be a great gift, but you need to be mindful of the special rules. So we just received a question about fee deferrals. Which was an excellent question. And the question was, I have an interest in an offshore hedge fund fee deferral, and this is a grandfather deferral under what's called Code Section 457A, that under those rules and the grandfathering rules, I need to receive, I need to basically take that into income, before January 1st, 2018. Can I gift my interest in my fee deferral now, to a charity, so this way I don't have to pay tax on, all of that income when it comes in, and be able to get, a charitable deduction? So unfortunately, the answer to that is you can't gift it in order to be able to escape paying the tax on that income. There is a concept called, assignment of income. And under that concept, you can't basically transfer your rights to income to someone else in order to avoid tax on it. Instead, you could, you have to pay the tax on it, but in order to be able to reduce your tax bill for the year, for those of you that are sitting on very large offshore hedge fund fee deferrals, it's obviously great to be able to make a donation, of the cash, in order to be able to reduce your tax bill, for the year. So we have a few other questions that, came in that we would like to, now talk about as well. So one of the questions that came in was, if you have a partnership that holds an interest in condos and you gift that partnership interest, what's your deduction? Are you able to get, full fair market value, or is your deduction limited? Karen?
Well, I guess it depends. So,
Karen, are you there? We're having trouble hearing you again.
Sorry, here we are. Can you hear me now?
Yeah.
If the partnership holds condos, and those condos are being leased out, and they're being depreciated, and you're giving that partnership interest to a charity, there's going to be some reduction in the value to the extent it relates to if you were to dispose of those condos, and it would result in some ordinary income or depreciation recapture. So it really depends.
And if the partnership actually is selling those condos, then potentially everything could be, your deduction could be fully reduced in that case.
Absolutely.
So I think another question that came in is, and this came up, as a result of one of our slides, which it said the charity should consider taking a gift of an interest where there's potential liability concerns in a single member LLC. So the question was, charities said that they would only take my interest if I contributed to a wholly owned LLC. Does this impact my deduction? Well, on this one, unlike some of the other questions, we have great news on. The IRS clarified a few years ago that whether you make a gift to the charity or whether you make it to its wholly owned LLC that's disregarded for tax purposes, the donor gets the full deduction. The LLC, itself, because it's a disregarded entity, doesn't need to have its own tax exemption, the donor would be able to get full tax exemption if it makes it to the LLC instead of having to make it to the donor and then the donor contributing it to the LLC, which would be bad from a donor if a donor wanted to do this for liability prevention, because then the donor would be in the chain of title. So no tax issues with that. One of the other questions we got was, and I think we touched upon this, is there any impact to me if the appraisal I receive is different than the sale price for the underlying property?
Well, I think we talked about that a little bit. You make a charitable contribution to charity and you have your appraisal, and then the IRS, the charitable organization files a Form 8282 with the IRS showing that the selling it at substantially less than the valuation. There's going to be some recapture of that charitable income tax deduction.
Right, but if the appraisal is a qualified appraisal, like we spoke about
if it's a qualified appraisal, the IRS could come in and challenge it. But if they did challenge it, they would want you to recapture that amount.
Right.
The question is, they would, and I should have said this before, they would have to examine the return to determine if that would be the case.
Right, and as long as the appraisal, was qualified, in most cases, just because the sale price was different, does it necessarily mean,
No, it would be a discussion on audit. If you knew that the charity sold it for less, you wouldn't automatically go in and recapture a charitable income tax deduction. You'd wait to hear from the auditor if there was indeed an audit.
Okay, great. And I think one of the other questions we received was, I want to give an interest in real estate. Will there be any transfer tax consequences to me? And we didn't really discuss that today, since those are really more state and local concerns, and obviously you would need to look at the state, but at least in New York and most states, if you're gifting property without consideration, there generally shouldn't be a transfer tax issue. The only potential problem is the rule is without consideration. If the property is subject to a mortgage, then that mortgage is viewed as consideration for transfer tax purposes. So if there is a mortgage, you would need to look at the specific state or city jurisdiction to see if there's an automatic exemption for a transfer to a tax exempt, even if potentially, there is consideration. So for example, in New York City, there's an exemption for a transfer to or from a tax exempt, so you wouldn't have to worry about this issue. But I guess you need to look at, if you're transferring encumbered property, not only on the federal side, but if we're talking about real estate, if there's any transfer tax, deductions. Limitations based on the fact that the property is mortgaged.
One thing that we haven't mentioned, we talked about all these rules, and let's say you jump through all the hoops and you get your charitable income tax deduction. One final note, it's required for the charitable income, you need a receipt, a contemporaneous receipt from the charity. You need to have that in your files, or else your charitable deduction can be denied. You can jump through all these hoops, do all the right things, know the amount of your charitable income tax deduction, but you just don't have an acknowledgement. That's going to be a problem. You need to have that acknowledgement in order to take the income tax deduction.
All right, that's definitely true. You make sure all your paperwork is in order to be able to give that gift. Well, thank you. So I'm not sure if anyone from JCF was going to make any concluding remarks, but I think from Karen and my perspective, the takeaways is that there really is a way to be able to gift property before potentially an exit event, or just, property in general, where you're thinking about potentially, disposing at some point in the future, or even property that you're not planning on disposing, for example, interest in a personal residence where you'd like to, let's say, keep that residence for your lifetime, but, after, your death, you'd potentially want to donate the interest in that property, but be able to get a current tax deduction for it. There's a lot of great rules, very favorable rules in the code to be able to maximize your deductions in that case, but there are also potential pitfalls both from the tax side and also things you need to think about from the non-tax side, whether it's making sure you're protected, or you're helping to protect the donee organization from a liability perspective, making sure that they have appropriate information, to obviously the tax rules we spoke about on making sure, from the donor, from your perspective, that the value of your gift is maximized, your deduction is maximized, and you're not going to have limitations under the partial consideration rules, such as the bargain sale rules, or by transferring only a partial interest.
And one final note is I just wanted to note it's always better to give during life than at death, because you get a current income tax deduction and it's out of your estate. If you wait till death to do it under your will, you're not going to get that additional income tax deduction.
That's definitely true. Always better to give early and to give, as Karen said, during your life.
Well, that's a great point. I wanted to thank you both for a terrific and very comprehensive presentation. I'm sure it gives our donors a lot to think about. We have taken gifts of all kinds of assets here, artwork, condos, property, shares in all kinds of LLCs. So it's something we're happy to explore with donors to answer your questions. I will say, though, at JCF, because this is an expensive and complex process, typically we do not vet or entertain gifts of real property under $500,000. So it's really when you're thinking about making a more significant gift and adding substantially to your fund that we would begin this conversation. On our website, there is a policy statement about gifts of non-marketables that you can get information there, or you can reach out to me, Ellen Israelson here at JCF. I'd be happy to give you some more information. And to both of our speakers, thank you again for a wonderful, wonderful presentation.